Good morning and welcome to Equity Story Trade Watch, the 16th of November, Wednesday. Welcome, Claude. The two of us again today on Wednesdays is going to be the norm, so that's going to be fun. What I just want to quickly mention is, before we start, is the Equity Story disclaimer. Of course, everything we talk about, as it says on that little screen, is in general nature only. Claude, I just want to quickly mention before we get into the stocks, because there's some interesting announcement today, a few reports, a couple of things that happened overnight. First of all, we had a pretty good market in the US, which was a good lead-in. However, there's a little bit of a escalation in Ukraine, which has put a dampener on things, where a couple of missiles, but looks of them, have crossed into my country, Poland, which is obviously not good, because that's probably going to mean some sort of response. I don't think it's going to be, drastic response, but probably some sort of a rebuke response on the borders of Poland and Ukraine. But that's obviously weighing on the market at the moment. So we're just cautious to see how that sort of transpires, and we'll see what comes out of Europe. Apart from that, the other thing I want to, maybe we'll talk about maybe throughout the week later on, and we'll actually definitely talk about it throughout, is the China-Australia first sort of thawing of the freeze of relationships that we had, which means possibly, if some of the tariffs have been taken off in the future, we could see some good, maybe theme re-establishing itself, and that is with China and some of the stocks here in Australia. So I want to talk about that at a later date, but I just wanted to bring it to our attention that there are some stocks that potentially could benefit out of that, with A2Ms and TWEs and some other stocks out there as well. But I'll make a list, we'll talk about it, but it's a good sign for us anyway here in Australia. Alrighty, I'm going to change screens now and go to, we're going to go to the charting, and we'll start talking about stocks, because there was a number of interesting stories today. So just bear with me for 1 second. Here we go. New screen comes up, and I've got first one of the rank, and that's yesterday's afternoon, and that's Whisper. We've talked about it to death yesterday, so I don't want to really mention too much about it. However, me and Claude, yesterday we talked about it on ATA, because there was a question regarding it. There was a big spike in the share price due to the fact that Whisper said they're going to sack about 30% of the workforce, which equates to about 80 people, which supposedly be saving about $14.3 million. However, I think you said, Claude, that it's still not enough. We need way more than that with the cash outflows that you had to look through, which I agree with that. I think it's way too premature to see exactly what the impact will be. Good jump, probably should have been selling the strength that we saw yesterday, and probably still should be selling this strength if to be honest, and see how it goes. Look, they needed to do something that they did. Maybe it's not the right thing so quickly to do so, but so be it. We're just going to be watching it. Pretty much it. We're out of it. We're watching it. That's it. Let's see what happens from here. All right, let's move on to the next few things. So we've got ARU. Now, I just want to mention that one first of all, we like the space, which is the rare earth space, and Little Arafura is a developer, let's call it, at this stage. Very nice chart actually on the weekly, when you look at that. If we look at it on a daily, let's have a look what's going on there. But the reason I want to mention that is that announcement, and that is I think they're getting all approvals now in place from the Northern Territory government. So all they need to do now really is push the button, start developing that thing. However, how much it costs them, and I'm sure it's going to cost them quite a bit. But it's one of the really more advanced rare earth place out there, apart from obviously Lynas, which is the producer. So want to maybe trade from here and there, possibly to trade looking at the moment at the end of the week, if we sort of see that sort of chart like this.
I think I'd said previously that although I don't know about the individual miners, I do like the rare earths thematic for the next year or so. And that was even compounded when I've got a friend of mine who works in sort of energy policy, and he was sort of saying, yeah, there's going to need to be more rare earths one way or another. Obviously, don't know who the winners will be, but I still think that, yeah, it's an interesting space to be in. So obviously be careful with the chart, because these things are still high risk, but it could be a good thematic.
Certainly. And that was actually an interesting article. One of the fundies was out at that conference, a rare earth conference, which was quite interesting. Not many people apparently went there. He said he was the only fund manager out there. But he wrote a nice article on Livewire, right? Talking about the differences between the different deposits, because this is all he learned from this conference, the deposits about monazite.
Was that the ANU conference?
Yes, that's exactly right.
Yeah,
That's
so that was the one my friend was at as well, and he was
okay.
texting
So
me
there you
being
go. So
like,
there's
"You got to look at these rare earths." Yeah,
exactly.
and
So
he doesn't work in markets or anything. He's just purely from the policy perspective.
fair enough. Fair enough. But it's coming out of that, obviously, with your friend, with this guy. They are just educating people, right, with what they saw, what they heard. And like I said, I posted it on our website, this article, because it was very interesting, very educational, actually, to see the differences. Every single deposit, by the way, is going to be different because it's so complex using deposits, because it's not just a one mineral that they've actually have. The rare earths is actually made up of several elements out there, right? So every deposit will be different and unique to each other. So you cannot say, we've got a discovery here, it's going to be the best in sliced bread. It doesn't work that way. And some elements are more valuable than others, more, I suppose, more demand for it. So you just got to look at it as a bit more in depth to make a bit more of a better judgment whether it's a good or bad discovery or a project. But anyway, that actually brings me to the next thing, Claude, and that is a little company that we're following, right? Called WA1. Now you probably go to this chat and go, "Oh my God, what the hell is going on here?" Right? But there's a lot of punters in this, and we've put these punters in here because of the initial discovery that was, I think, around here, around the buck, and we said get in, right? So people already made double their money here. We're obviously waiting because this is a discovery with no niobium and rare earths and phosphate. So a very unique. I haven't seen it like this before, right? It's a very unique, especially in Australia. So it was nice grades too for the niobium and obviously some nice grades in the rare earths side of things. So from that perspective, it got the market very, very excited on the initial discovery. Now, they have actually, yesterday or 2 days ago, going into the trading hold, saying we've got a more announcement regarding further possible discovery. So anyway, they come out today, said, look, we found another pipe of this carbonite that's got the niobium, the rare earths, and the phosphate. It looks very similar to the initial discovery. So this is the initial spike we've had, right, to about $1. This is when we got in. And it looks very similar. But the thing is, it's 30 kilometers away. This is crazy stuff, right? So it seems like they've hit something pretty interesting and they've got probably something well worth following. But they've played it so well, Claude, because now they've gone in a trading halt. At the same time, they've announced a second discovery to raise some cash. That's exactly the way you want to do it, right? Do it while the iron's hot. Where they've got actually another discovery with the actual market hasn't moved on this announcement yet. So they can raise whatever they want, really, and it probably will still spike on the back of this announcement. So I'm intrigued, but well played to WA1. Whoever's in this, hold on, let's see what the reaction is, see how much they're going to raise, see what price they're going to raise it at. We're going to find that out in the next 2 days, but good luck to everyone who's in there. And like I said, I hope this is going to play very well at this stage. And it's still only, when you look at it, market cap's only about 50 odd mil. So it's got a potential there to keep going up and up and up. I mean, I've seen some very average stocks, 200 million market caps plus, right? So I think this is something pretty interesting, something unique that probably will keep getting the attention of the market here. All right. So we talked about that one. We're going to do it. Next one is NUF. And New Farm come up with today with their announcement. It actually looks like a very, very good looking chart. Possibly, you might buy this on the daily, but I'll just be waiting till the end of the day to see how it actually finishes up. The weekly doesn't look too bad, but the actual announcement wasn't too bad. I'm not sure if you saw this today, Claude, but from a big stock perspective, it's actually quite nice to see a decent result. And it's probably in the right space, agri space, having the crop protection and the seed business, and a positive outlook to boot as well. So I think for me, it's going pretty well at the moment, and possibly maybe on the way up back to that $6.60 that we had before. So potentially there's a trade here happening over the next few weeks. Anything to add?
Oh, look, it makes sense. Maybe there's like a medium term tailwind with like decent crop prices, but at the same time, you got to remember that agriculture is notoriously up and down, and these guys are sort of providers to the agricultural industry. So yeah, it's not a quality company that I would long term hold. Put it that way.
All right, fair
But
enough.
medium term, maybe it's a trade.
Yeah, absolutely. I think you're probably right. There's probably a trade here. At the moment, the tailwinds are still with it in the agri space. So potentially, yeah, you've got maybe 6 months to play this out, get it to 660, take your profits and move on. Overall, I'm not a super fan of NUF with the crop protection. They use things that maybe are not very good for their health. But it's always been controversial, I suppose, in that way.
Definitely.
While on that theme of agri space, there was another one that's GNC, so I'll jump to GNC straight away. Another stellar result, really, from GNC. Up the dividends, everything was up. However, the share price performance maybe not as great as one would expect. It's hard.
I think a lot of the tailwinds got priced in fairly quickly after the Ukraine war started, and if anything, the grain shortage hasn't been as bad as what some people predicted.
And I think you're right there in a way. People are obviously going, what's next for GNC? Possibly a lot of this upside has been priced in. However, the thing is, it's hard to predict how long this war will go on for, where the prices might be of things. So you might have another move somewhere along the line. But for the moment, I think the market is basically saying, yeah, we know you're good. You've come up with some good results. You've probably had a good couple of years of really strong results with a positive thing. And I think they said in there, they've had 3 years of consecutive positive climate, right, where they've could do very, very well for themselves. So as an investor in the agri space, 3 years in a row of really good weather conditions is usually something as an anomaly. Usually you get a 1 or 2 and that's it. You get a pretty bad one. So they've done it pretty well. So I think maybe the market's going, probably the next one will be pretty bad. But anyway, look, it's
how long can the luck last? Not sure about that.
Exactly. So I think the market's sort of like going a little bit scared. But well, it's okay. It's okay. If you're in there for the dividends, you're probably okay. But probably the same thing with NUF and these guys. You maybe have another 6 months, and then we'll probably have to reassess where to go from here. However, the chart's not as good. So, whether you're sitting in there for the dividends or something else, it's entirely up to you. Trading wise, you definitely wouldn't be in this. All right, let's move on to the next one. We've got JLG. This is one of our favorites that we've been following and making some money on over the last few years. It's been looking very well for us. This is a daily, which looks okay, quite positive. But the weekly, you could probably say it's looking actually quite decent. And a couple of little small acquisitions, really little bolt-ons. To me, immaterial really, because they didn't pay that much. However, they're talking about being accretive from day one and so on. Yeah. But very small acquisitions. It's really not much for me to really get excited about. A couple of strata things in Brisbane, but that's it. I still like the business as a whole. The only thing I can really say negative against it, it is very expensive. So, from a value investor, you probably really have to close your eyes and if you're going to buy it. From a long-term investor, yeah, decent. We're still holding in there if we're in this. From a trader point of view, possibly a trade here as well. Maybe back to that $7.58. Anything else to add to that?
Not really. This one's a bit too large for me to have looked at closely, but so yeah, I don't really have anything to add on top of what you've said.
Okay, let's move on to the next one. AFM, a little-ish tech stock in their car industry, I believe, and it's got some software that they sell to the car yards when you book your car in and get it serviced. So this is not I don't actually mind this business. It's actually quite global and it's got some nice revenues. They've come up with an update today. However, the update wasn't great because did really come up with some negatives in there, saying that they're struggling, that one of the part of the business is just not recovering as they think they would have been. Do you know anything about this company at all, Claude?
I kind of do, yeah. I followed it over the years. It's sort of been a legacy software business that struggled to really maintain any kind of growth verve rather. And look, some years it grows. In FY22, it said it grows organically by 8%, which isn't particularly fast growth. And and it's also, grown by acquisition as well. So these guys, I was most recently following them because they had actually a while back a couple of takeover offers.
Yep.
And then in the end, those takeover offers fell through. So,
That was
I haven't gotten across the latest numbers. Do you don't happen to have them in front of you in terms of what happened today? Because we see the share price is down on this
yeah, I saw the
AGM
numbers.
update.
Yeah, I saw the numbers today. They come up with the revenue numbers, but they also said in the outlook that one of the businesses that they've actually bought, the growth that they were accounting for is not eventuating at this stage.
Yeah, right.
COVID issues plus I think the parts that they normally send, they've still got issues with sending them overseas and so on. So there's a few teething issues going on at the moment. Hence the downgrade today, really. Hence it looks like they're back to $18. And you can see why probably those potential acquirers probably walked away, right? They just saw too many issues, not enough growth. And they thought, for the moment, we can probably pick this up much cheaper, probably in about 12 months to 24 months time.
Yeah, they're saying reported profit will include one-off restructuring costs for cost out initiatives and one-off bid response costs. So it's probably looking at a weak result basically in FY23. And so that means that, the PE ratio that we're looking at the moment is probably not even, not a good representation. So look, I think I would not be surprised if, as it turns out, that right now we're currently in a valuation that's low enough that means that this business will be okay. It's not, it's not going to blow up. I don't think. It's got a lot of pretty sticky business. So yeah, look, it's investable. In terms of, do you know what the revenue this year was for them? I
can't remember. I did see it.
So because they've got an acquisition, there's some acquisition growth going on there. I've got it back up now. So this year they did 120, and they're forecasting 127 to 132. So yeah, look, there's going to be some revenue growth, but it's acquisition-led revenue growth, and so that's why the market's disappointed. And then on top of that, we're going to have a weak profit result in this year. So, they said it's going to be hard for them to grow underlying cash profit. So yeah, look, ultimately it's probably looks fully priced on the FY23 numbers. Pretty easy to believe that if they do some cost out, etc., FY2024 probably looks better. At that point, you might kind of get an uplift. Having said that, you're probably not in too much of a rush to buy, given that the FY2023 results are probably going to be weak. You could probably wait at least until the next results, and I highly doubt the share price will have taken off by then. Probably, I would argue, having followed this one long term, it's the kind of company that is more in decline than in its flourishing stage. You can see that on the long-term trajectory of its share price has been mostly struggling and mostly heading down, sometimes getting too cheap, maybe get a takeover offer. But yeah, not a high quality business. It's one you could do some bottom picking on and try and get at a cheap price if you wanted to. But even then, I reckon best case scenario, it'd be more like a medium term trade. You're looking for, those FY24 results are going to be good. There'll be an uplift. I'll sell it there. So not the most attractive opportunity you're going to see.
Yeah, I agree. Pass for me. I think normally what I tell everyone is if there's a downgrade, there's usually a negative tail to it. So there could be a number of downgrades. Once that stops, that's when you sort of get into this sort of story. And you could see this back at 50 cents, right? If they come up with 2 or 3 downgrades.
For sure. This business has failed to get any sort of good secular, long-term, sustainable organic growth for many years. I've watched it for a lot of years now. You could go and take that 10-year chart and you're going to see the same thing, which is just sort of bumping up and down. Some years are good, some years aren't so good.
That's it. Okay, fair enough. Move on to the next one, RFT. Look, you probably don't know much about it, to be honest. I
actually surprisingly have followed this one for quite a few years.
You can talk about it. Come on.
I actually bought this one. I bought this one when it was 003 was its price, many years ago. I didn't hold on. It would have been a massive 10 bagger if I had.
Yeah.
Didn't hold on to it, but yeah, one I've followed for a long time. I like it as a potential exposure to the electrification megatrend. What they do is they supply the rectifier modules that are used for a number of different kind of electronics, but their biggest sort of growth market at the moment is is electric vehicle charging, like their components go in that. Their announcement today, they've received product purchase orders from iCharging Mobilidad Eléctrica, totaling $22 million for the supply of a customized version of the RT22 charger module for their Blueberry range of DC fast chargers. And they're saying that's going to be fulfilled before the end of the 2023 calendar year. So presumably falling in, a bit of second half this year and first half next financial year. And look, it just goes to show that they're continuing to benefit from demand that is arising from the electric chargers situation. So yep, can't say I own shares in this as we speak, but I have owned shares in the past. I consider it an investable little small cap, but a lot of operating leverage in there. You got to be prepared for a bumpy ride. Last results were just $500,000 profit. Not a great result really there, despite higher revenue. And look, I think we're going to see that profit result improve over the years. For now, however, though, you've got to look at it and be like, all right, that's a $75 million market cap after the 45% rise today. So for this to look good, you probably need to have at least $5 million profit. And that's 10x versus the profit they have right now. So yeah, they're going to get improved revenue, and that's good and interesting. But I would say that this is one you want to probably, if you do want to buy it, you probably want to buy it when it hasn't had a good announcement. The share price is languishing a little bit more. These guys can go a long time without announcements. If nothing happens, it can go down. So I would say that it's not looking super cheap right now after the rise today, but you could buy a small position and hold long term, because I think it's an investable little small cap that's working hard to make shareholders money. That doesn't mean it'll succeed, but it's got long-term demand tailwinds. I think it's got honest, competent management. Very hard to speak to them, by the way. I just say that having watched them and what they did for 10 years. And so, yeah, I like the story. It's one for the watch list. It's on my watch list. I consider it when it sort of drops around 3 cents, it starts to look more interesting to me, but the most recent results were kind of weak. So yeah, speculative at best at these prices.
I agree with you. And the thing is, they've done this before, right? So big order here, up, down, big order here, up, down. So it's very
because the problem is they've got that revenue growth, but it doesn't necessarily translate to profit yet, as they're trying to grow as well, because it's capital intensive. They have to invest in machinery, their workshops, their inventory, all of that kind of stuff.
I wonder what the actual margins are of this. What are the margins of these things? And it doesn't look like it's amazing. So
well, it's not going to be amazing, I don't think. Like for this kind of device, which is not even a direct to consumer device, it's like a bit that they sell to someone else who's making the thing that then exposes it to consumer. I think that probably the sustainable long-term margins would be about 10% at best. Like if these guys over the entire, over an entire cycle could average a 10% net profit margin, I think they'd be doing quite well for them. And I don't think they're going to be able to maintain any much higher than that either. So overall, yeah, we've got to say, okay, 16 million receipts from customers in the last year, let's say 15 million in revenue led to profit before tax of just over 1.2. So it's probably at the moment, we couldn't even say they're going to get 10% profit before tax margins. So let's be a little bit conservative and say, okay, net profit margins of 5%. Well, even when they get their revenue to 30 million a year, which is double where it currently is, that's still going to be like $1.5 million profit for a $75 million company right now. You can do the maths, but what is it? That'd be a PE ratio of 50 still. So look, it just comes down to price for me. If this gets cheap enough, I reckon it's worth it as a buy and a buy and hold, just because I do think that they will be improving their profit over time, and they'll probably have some really good results once in a while. But, I don't want to overpay for this, because yes, it's going to have a good few years because it should benefit from this electrification trend, but you can't be guaranteed that actually profits will be there. And if you're buying at this price, I feel like you're probably just hoping that the hype takes you higher, and so it's not cheap for me.
I agree on that completely. For me, no, it's just way too early. I think, yeah, I'd rather probably, if I'm going to be looking at, I like the space, but if I'm going to be looking at, I probably want to, like you said, probably getting closer to that 3 cents. And I'm not buying the FOMO type one-off big.
Yeah, at 3 cents, it's like under 50 million market cap. So you can more easily imagine how it gets to a P ratio of 20 from there.
And even for traders out there, you guys, it's just, when you probably wait till the end of the week and probably have to give it another week to see how it follows, because every time they had a big one, follows with red. So don't touch it. Wait till next week and see what happens. All right, so let's move on to the next one. I'm mentioned PLS, just from the point of view that today they've announced that actually going to be paying dividends. So for those for those that are that are following this story, that are in it, there's a bonus for you, and maybe that will give it a little bit of a boost, because of course that space has been under pressure the last couple of days. So yeah, from next year, I think they're going to be paying some dividends, which is great for PLS shareholders. Next one, SGI, and let me see, Stealth Global. To be honest, Claude, I know nothing about this. Do you know anything about this?
Yeah, I know a little about it, and our viewers may have also caught up on it before. I think Andrew Page was on a few times with Dave. They talked about it. Andrew kind of quite liked this one. These guys do a distribution of what is it? It's like work clothes and stuff, Stealth, and other tools and tool bits and stuff like that. It's a distribution group for tradies, basically.
Like a
so United Tools.
Reseller, yes? Is that what it is?
Beg your pardon?
Third-party reseller.
Yeah, sort of. Like they distribute to like industrial products to like the people that use them. So tradies, they own the C&L Tool Center, which is industrial hardware and tool product supplier specializing in workplace supplies, tooling, welding equipment, and safety gear. Heatley Safety's Industrial supplies a wide range of quality, safety, and industrial products to all facets of Australian industry. Basically, they're a wholesaler, you could say, or distribution groups in serving tradies or that kind of thing.
It's like a Dicker Data of the tradie world.
Yeah, you could definitely argue that, but of course, like as I always say with the old distributors, it's easier to get a better margin as a distributor if you're in an environment that's like, I guess, first of all, like an oligopoly, there's a few players, and then at the same time, there's also a tailwind, meaning there's constantly more and more volume across that distribution, which is why Dicker Data has been able to do quite well. It's just a strong tailwind with more revenue. It's easy for them to grow revenue. And on top of that, they have quite a lot of scale. They're in a sort of oligopoly situation, and they're just able to be a little bit more efficient than competitors, which allows them to have slightly better margins. These guys haven't yet really proved themselves in terms of being able to what sort of sustainable margin can they make. Obviously, I would argue that the kind of safety gear and stuff that they are distributing, it's going to be lower margin anyway. So already distributing kind of wholesale groups have pretty thin margins, can be like 3 or 4%. Or these guys are going to be looking at a really, really low margin on revenue, and not the strongest balance sheet from either, from what I remember. And look, today they've put out an update. I feel like sort of typically for them, it kind of just gives you like half the information, that not really enough to know exactly what's going on. So they said revenues increased in 4 months to 36 million. So they're doing over 100 million revenue per year run rate. But that's also partly driven by acquisitions. And then they say, Stealth plans to further right-size the group to yield maximum profits. I think that means that they're actually trying to buy more things to get more scale, so they're profitable, but I'm not really sure. And in terms of that, they also saying they're simplifying the business. So they've got new contracts, they reckon. That's going to be even more sales. They love to talk about sales. They say annual cost savings combined with increased margin profit from platform enhancements, pricing reset, growing customer activity, improved purchasing terms is expected to deliver approximately 2.2 million in additional profit in calendar year 2023. So I don't know why they're talking about calendar year. Yeah, like it's always the information they give. It makes it so hard to actually figure out, like, why don't you just tell us how much profit, if any, you made in the last 4 months? But it's like they
Companies do
give
like
you,
to be cryptic, don't they, sometimes?
yeah, exactly. It's like a riddle inside an onion. And that doesn't give me a lot of faith when you consider that these guys, have a lot of operating leverage in their business. Now, having said that, profit from continuing operations before income tax was 700,000 in FY 2022. So they were profitable. They're saying they're going to be more profitable. Somebody could surmise from this that they might be saying, oh, they're going to have a great increase on profits. Maybe they'll make 3 million profit before tax this year. And that's going to put them in a really good situation. So I could see how someone could look at this if they're a believer in the company and certainly think, oh, this is bullish. That means it's going to make 2 million NPAT or something like that. And then they could say, oh, the market cap's 13 million, 2 million NPAT's going to be on 7 times earnings. And that might be true. But that's not really what they've promised either. That's what you got to remember. They've actually given us a riddle inside an onion that could lead you to believe this. But I would at least want them to out and out say, we are going profitably. We are on track to growing our profit before tax, blah, blah, blah. But they didn't say that. So I think it's important to think about what they didn't say as well. And overall, I would just sort of be like a little bit skeptical about how profitable these guys really are.
All right, so just charting wise, it looks okay, but there's no trade in there at the moment, I don't think, I can see. And just from what you just summarized, I think they're obviously going okay at the moment. They are on probably got a couple of tailwinds there going there, but for the moment, just give it another maybe couple of halves and see how they go.
It's not terrible, but like I'd love to see a half year where they actually look like they are on track to make that good profit and even have that backed up by cash flow, which we certainly didn't see in the last half. We just saw a paper profit, no actual free cash flow to back it up. So yeah, overall, just pretty skeptical about this, but open to the idea that it's cheap if it does get its act together.
All right, so one for maybe February to reassess to see where they're at.
I think so.
Next one, OZL. Quickly with OZL, just trading holds. Looks like BHP is back to the party. They made a bid previously, was rejected. Let's see what they say this time around, but they are trading holds, so we'll probably have to wait a couple of days. CLG is the next one, come up with an update. I don't mind this company because it's in a space that we really like, Claude, and that is recycling. And it's like what they say, they've got, the full, I suppose, cycle of it. Do you know anything about this company at all?
Look, I've had a quick look at it. So just keeping in mind that my general sort of filter is that I do generally de-emphasize capital intensive business, which these guys definitely are. And so as a result of that, it's more one that I would consider if I thought it was really cheap, rather than one that I would just sort of jump on because I think it's high quality. I like what they're doing. I think there's a space for that, and I hope they can keep it up. Just having said that, I do actually think they're in a tough business, so I'll probably want to get like a fairly cheap multiple there. And just having looked at it, it's just not been cheap enough for me. It's, like the profit before tax was about 3 million. So it's not super profitable. I just want a little bit longer to, I guess, establish how reliable their profits are. I think they, guys might have had some problem with one of their plants as well, the plastic recycling one. So yeah, I think that's correct. And so yeah, overall, I like it. It's interesting. It's just not cheap enough for me at this point. I'm not across what it said today, although with the share price up 12%, you'd actually argue that that's a good sign. Let me see.
I think just overall, they were saying that things are going quite well for them.
They said revenue to increase 20% on previous year, and EBITDA margins to be online with previous year. So all else being equal, you might expect these guys to be doing, somewhere between 3.5 and 4 maybe million, let's say, even just to be conservative, 3.5 million in net profit after tax in this year. based on what they're saying now. So probably still reasonably expensive, but not too bad.
Okay. So for me, another one of those, wait till February, reassess.
Yeah, probably I'd say so. I think it's just too expensive, but let's see. Might be wrong.
Okay. Let's go to the last couple. CHL. I know you have been following this one a little bit. So
yeah,
please have a look at this one for us.
Yeah, look, CHL need to do a little bit more work on it because I need to start thinking about when I do want to dip my toe in and get back into this stock, to this story. Look, usually I'm very sus on just growth by acquisitions. You know, you really can't extrapolate growth by acquisition growth rate. Obviously, it comes with a cost in terms of dilution and funding of those acquisitions. And Camplify, sure enough, has been doing a fair bit of growth by acquisition. However, I do make an exception in Camplify's case in terms of my perhaps harsh judgment on growth by acquisition. Because what these guys are actually trying to do is they really want to have a website where it's the go-to if you want to hire a van or a trailer to do a little driving holiday like that in the camper van. They want to be the go-to. And to be the go-to, you know, they best have the most number of camper vans of everybody. Equally, they want to be the go-to for somebody who wants to rent out their camper van and make some quick money from what would otherwise be just sitting in their driveway. And that's the core of why this business makes sense, because you have an asset that's in your driveway that might not be earning anything. And through Camplify, you can then start getting yourself, you know, hundreds of dollars or thousands of dollars a year just from renting it out when you're not using it. And it's that sentence, when you're not using it, that is so important here, because that's what allows Camplify to get like fairly generous takes. Because your option as a consumer is you either can't rent out your trailer or you can on Camplify. So you're happy enough to pay up to 30% to Camplify to sort that out for you, especially if that takes care of insurances and minimizes the risk to you. So they're creating real value by monetizing an asset that's just sitting there. That's why this is a real business with real potential. And in order to win that, they want to be the one that is the biggest. And that's why these guys are going after acquisitions, because they're the biggest in Australia. They want to be the biggest in New Zealand, and they want to be the biggest in Europe, in those countries where they operate. Now, they're nowhere near that in Europe. I think they are the biggest in Australia and New Zealand. So that's a good thing there. But they've been raising capital. They've been buying stuff. It's not pretty, but it could really work. And if we're looking at sitting here in 5 years and we're like, they're the biggest in Germany, they're the biggest in Australia, the biggest in New Zealand, they're the second biggest in France and Spain, and you know, they've got a presence in the UK or whatever it is, these guys will probably be able to make a good profit by then. So very interesting speculative stock at this stage for mine. And I definitely want to be on this story if it turns out to be, this is actually the kind of company I look at, right? Because it could be a multi-year, multi-bagger, because clearly this is creating a new market where they can have good margins, and it's quite likely it will be a winner-take-all or oligopoly kind of market. So going to be a good quality business one day. The risk is, of course, how many shares do they have to issue to get to there, or do they ever actually lose the battle and maybe somebody else wins? Either way, hard to price, definitely high risk. Obviously been sitting out of that as we've had this huge risk-off cycle. I don't know if you think the risk-off cycle's over yet. I don't think it is quite over yet. However, this would be the kind of one where I'd consider buying it. Look, even if I think it's still going to go down, I'd consider starting to nibble, just because I definitely probably want to have some exposure to this company. And I don't want to be in a position where if it does start taking off as we go into a new bull market, I don't want to be like chasing necessarily. I prefer just have a smaller holding, even if I know that I've perhaps overpaid a little bit and haven't got that bottom. I do want to be part of the story at some point. So someone has to tell me when to buy this at some point.
Yeah, look, I agree with you in probably a lot of parts. You know, I think the business might have a bright future if they play their cards right. I actually don't mind the business at all, where, you know, you can rent out your idle caravan to whoever. So I like them. I think what worries me is they're doing too many things at once, too quickly.
I agree. They're trying to sell caravans. They're trying to go into insurance as well. And also they've got this model where they like rent out the stuff as emergency accommodation to the government, which is not such a bad idea. I actually quite like that one, but I do agree it's a lot.
Yeah, so it's for me, normally it's a recipe for this stuff, because you sort of fall into the too many things at once, you get yourself caught up. The other thing I have to question, I've just read through that actual announcement. The one thing that they mention here is that, we're coming into a tougher period where people are tightening their belts, so we'll be well positioned with renting our car. I'm thinking, no, if I'm tightening my belts, I'm not going to go on holiday. I'm actually going to save my money here. I can go out 12 months without a holiday. So I don't know what that premise is of they thinking that if there's a recession, people are still going to go and rent a caravan to go on a holiday.
Yeah. I think that's an interesting point, and I'm glad you made it. Look, yeah. So for viewers, what Camplify is trying to say is they're like, oh, we're a low-cost, affordable holiday. So, if the recession bites, then more people are going to want to come and get camper vans, I guess, instead of going on holiday to Europe or whatever. Yeah, I don't know about that. Like, let's see. I don't think that's necessarily true, because, like, okay, let's just say there's some guys that said we were going to stay in a 5-star hotel or a 4-star hotel. Now we're going to stay in a camper van. There will also be some people that were like, we were going to stay in a camper van and now we're not going on holiday.
That's exactly right. That's what I'm saying. I mean, people that go on a jet setting about Paris, not going to go, oh, we're going to camper van now. They'll probably be afford to holiday anyway, right?
Look, in terms of the jet set crowd, like the guys that are doing a big family trip to Paris, they probably, if there was a time they were going to go in the camper van, it was when they were literally were not allowed to go to Paris,
Exactly.
That was when the camper van boom was on, because all these people couldn't go overseas anymore. So suddenly that was on the table. Now, fair play to Camplify. I suspect they've kind of made good use of that to actually get their business up and running. But I'm a bit skeptical of this claim that they're going to do well in a recessionary environment. I think perhaps their growth and their market share growth is enough that they do keep growing in a recessionary environment, but I definitely don't think it'll be good for them.
But for me, they're setting themselves up for another fall if that doesn't come through. This is my worrying thing.
I think so, and they're probably telling that story a little bit now, right? Because they've done quite well to raise capital in a much tougher market than it has been. So probably that's sort of part of the narrative there that they were telling. All
right, last thing, so because it's been a marathon, so we're going to quickly go through this. Aristocrats, and just by the way, charting wise, both CHL and CLG just not quite there, so we're going to pass on those. Aristocrats come up with their update today, half year, I think, pretty good all around. No outlook. That I think what the markets decided to punish them for. However, look, I actually like this business. I think they've done remarkably well over a long period of time. They obviously positioning themselves, trying to diversify themselves, but there's a future for the online gaming. There's a future for the online gambling. This is where the gambling is actually going. So for me, there's something about Aristocrat that they're playing the cards very, very well at the moment. So for me, I'm still a holder of this. I suspect that over the next probably 3 to 6 months, we'll know a little bit more about the actual outlook and what they're expecting. But today's sell-off probably presents just an opportunity to get some stock cheaper. You probably don't follow it because they're probably a bit big for you. But from our point of view, we've been following this for quite some time. I don't see a problem with this at all. So for me, I'm still a holder. Have you got anything else to just finish that off?
No, nothing to add on this one.
All righty. Claude, we probably have to finish because we've been going quite a long time. So thank you very much for your time. We'll obviously come and probably do that Friday, hopefully ATA together. Apart from that, everyone have a great rest of the week. And hopefully there was no third world war. That's the important thing. Anyway,
thanks for the chat, Peter. Have a great day.
Thanks, Claude. Cheers, guys.